Back with another episode with my man here, Garrett Gatton, principal of Reinvest Capital. How are you today, my friend?
Doing great, man. We're in the middle of a lot of great transition right now, so you'll have to excuse if this was different than when you were on the podcast the other day.
Yeah, well, it's exciting that there's new moves being made. The chessboard is there, and it's up to you to figure out where to go next, right? So, with that said, before we get into the moves and whatnot, let's learn about yourself, your origin story, where you're living right now, how you got to where you are today.
So I'm in Northwest Ohio. Ohio classically has been a flyover state. But if anybody's been following what's been going on in the real estate industry at a macro level, Ohio is popping up as some of the hotter markets that are stable, achieving rent growth. So like the three C's, Cleveland, Cincinnati, Columbus. So we're nestled just outside of Columbus by an hour and a half, close to the Indiana border along I-75. And we're in kind of a tertiary market. But it's a lot of fun. It's a place where a lot of institutional investors overlook. And so there's some great deals in our backyard.
That's awesome. So you kind of mentioned the three C's there, and I've been hearing about Columbus, honestly, since 2017, 2018, having a really incredible resurgence there. So it's funny that you also mentioned that. Are you from Ohio originally? I guess I should start with.
Yeah. So I'm from Central Ohio, just an hour north of Columbus. And then I went west and still in Ohio.
Right. And what have you done? Because, we talked about this before. We share some of the same war stories because you used to sell homes. But take us to how, you got here today, your kind of career background, and which kind of shaped you with your thoughts, your principles, and beliefs into, the Reinvest Capital play.
So before even getting my real estate license 5 years ago, I came from the nonprofit sector. And so I worked with youth full time, straight out of college. And we kind of helped youth that were having instability in their lives find stability through faith-based principles, biblical teaching. So I was like a glorified youth pastor. And I always tell people that to be a youth pastor is the one job where the more immature you are, the better you are at what you do. And so that's what I did for like the better part of 8 years, kind of in college and out of college. Oddly enough, transitioned into raising money for that ministry. So now I'm raising money, but for real estate.
Very cool. So you went to that and then you went to selling homes. Is that correct?
Yeah, so I had made a contact with my broker who owned a local commercial real estate and investment grade real estate brokerage. Went to him. I said, hey, what are like the three things? What makes a great real estate agent? Because I was canvassing a couple of different opportunities. And he said, well, you got to be good with people. You got to be willing to work hard. And you have to get out there and network and just push the pavement. And so that was something that resonated with me. So I got my license. And I remember for the first 6 months sitting in front of my computer being like, what the heck am I doing? Because he would be like, hey, do this evaluation on a high level commercial property. And I'm like dinking around on CoStar, trying to pull comps from the MLS. And it was very clunky. And then I had to put this report together and then go talk to this sophisticated business owner and tell him why he should list his property with us. And so that gave me trial by fire. We did everything from like office leases to industrial listings, for sale, you name it, investment grade single family packages. And I just got a wide exposure to the wide world of real estate and investors and business owners. So that was a great experience. And that kind of set me on a trajectory of wanting to invest in real estate on my own, not just being the proverbial real estate agent that helps everybody else build wealth, but to actually do that myself.
Yeah, no, I can really appreciate that too, because it's funny about that, helping everyone build up their wealth. I think setting up and starting from the agent brokerage side is actually a very complementary skill set into capital raising and whatnot, because you've helped people underwrite their deals, pick good locations, you understand the why location, kind of the fundamentals as to what makes a good acquisition that you would look for a specific asset type. We're talking about homes. But a lot of those parallels actually mirror and match what would make sense for a commercial property, whether it
Right.
be industrial, whether it be multifamily, whether it be mobile homes, whether it be retail. What are the core pillars there? Location, the building grade of it, materials like that, inflows, outflows, how the debt is affected on this. I think my foundation is actually really amazing because I have that residential world. And then similar to yourself, do you feel like that's the perfect kind of pairing to what you're doing moving forward now?
You said it so well. I mean, people are asking you your professional opinion on them making an investment decision. Maybe they're an out of area investor evaluating, excuse me, something that you have listed. And they're relying on you as that market expert. And so I'm having to give them all of the data that I would then, as an investor myself, want to make a decision based on. I'm connecting them with lenders. I'm saying, hey, steer away from this. This lender, they want to see X and Y. And hey, they're really bullish on multifamily real estate. You can probably get a 30-year amortization with them. And so helping other people, you got to see the life cycle from identifying a prospective property, acquiring that, and then helping them stabilize that through like some kind of business strategy and increasing rents. So we did that, and that segued into our first investment. We had a client of ours buy, a portfolio of 26 properties in our downtown in Lima, Ohio. And they stabilized it. They built 2 new triplexes on the back parcel of an old brick 10 unit and rented it up, did 7 high-end loft apartments above this mixed-use space, and said, we want to market this and sell it for $2 million. And so they came to us from a broker perspective and said, go find us a buyer. And you have a short list of people that you work with that are the movers and the shakers. And we looked at this opportunity and said, maybe this is the time that we jump from agent to investor. And so, man, we fumbled our way through a $650,000 raise. It took 3 months to close the deal. The lender that had given us the loan commitment had given us a 30-year amortization, great interest rates. And then like 4 weeks before closing, they said, hey, we've hit our saturation limit on writing these kinds of loans for multifamily. So here's what we're going to do now for you. And it took a big step back from what they had said. So we had to re-underwrite everything, right? Because it changes the numbers when your debt goes up. Found another bank that was willing to do something that was competitive but not as good, and got the deal done. And I remember like after we got that closed, we all looked at each other and we're like, holy cow, we did it. Proof of concept. There's people out there that are looking for great passive real estate investments, and we have the ability to source these things. It was not pretty, but we did it. And that began the iteration of refining our processes.
Yeah, and I think just to piggyback off that as well, and I'm so happy you told that story. And I think at every point when you're in the sales world, especially when the market was super hot in 2020, 2021, and 2022, particularly in 2020 and 2021, where you were seeing people buying houses, investors and stuff, and overnight having, even a quarter later, like $50K, $100,000 in appreciation, or people
Yeah.
doing flips where it's like, wow, you're just timing the market perfectly. Or you bought a market rate deal and, you maybe put 80K into it and you just made 200 grand. I was like, okay, wow, I want to be a part of this. So that's why similarly, why I really was like, okay, there's a couple ways to skin the cat here, but you want to get to the investor side as quickly as possible. So that's why ultimately I really wanted to get to Lone Star. So I wanted to be on the principal side of things. I wanted to have equity, being able to roll into deals, have basically carrying these deals and get to the ownership side, because not only is that, where the money's made is honestly there, but the taxation, it's a lot more creative. And then you can start long-term planning there. You're not a mercenary just for more sales, deal after deal after deal, starting the year every single year at ground zero with basically no sales from a blank kind of slate, in a sense where, you could have sold 100 houses the year before, but now like the guy that sold one house, you guys are the same playing field. So not that of course you don't have momentum and clients and contacts to get there, but you're just having to reinvent the wheel every single year. Versus this, I feel like, not that residential real estate or commercial brokerage like that is not compounding. This just has such a better compounding benefit once you get to this side of the world. Have you kind of felt that way as well?
Oh, so this was like the big aha moment for me. Initially when you're starting out in your career, you have to get some very fundamental ingredients, right? So you got to have hard work. You got to have grit and that tenacity. And that's just like base level. If you want to be successful, you have to have that.
Doesn't matter what you're doing, where you're doing it in. Those are just key fundamentals. If you take anything away from this show.
Yeah, right. So start there, and you have to start there. Once you get that done and you've kind of been like, okay, this is the rhythm now of what it takes to be successful. My mindset has shifted and wrapped around that. Now you begin to ask questions of like, how do I go the farthest with the effort that I'm going to put in? So you begin surveying the marketplace in different industries. And in the real estate, agent side of things, to your point, it's a volume game. And the moment that you stop and celebrate because you have something closed, you've paused and you have to put more stuff in the hopper. And if you don't have something at the top of your sales funnel, you're going to feel a gap in 30 days where you're going to have no sales. And so it's this constant engine that's running and running and running. And it's really a rat race. There was an agent here in our community who was longtime agent, very successful, high volume, made a ton of money. Fast forward, she got to the end of her career, she retired, and I remember seeing one of her condos that she owned at the sheriff's sale. And I had kind of, through the grapevine, talked with some contemporaries in our field. And I said, hey, what happened to so-and-so? And she had never taken that money that she was making and invested it in anything. When you're 1099, you have to have a plan for your
No
long-term wealth
benefits.
strategy. There's none.
Yeah.
And so she found herself in a really vulnerable spot because she never made that transition. And when she stopped selling, all of her income stopped as well. And so I was looking at that and I'm like, starting out when you're investing in real estate, getting a foundation, that first level of horizontal income helps you to kind of mitigate the highs and the lows. It takes the edge off because you have a base level of income that's going to be there no matter what the market's going to do. And as you kind of stack on that, you become less and less dependent on your income from a real estate agent perspective. So that's kind of my plan, is to continue to do that and help other people do that. Now, with that being said, there's people that don't intend to leave what they're doing. They love what they're doing. They're doubling down on what they're doing and it's going really well, but they have this problem. I have a bunch of money and what do I do with it, right? And maybe I'm overexposed in the stock market and I don't like that. It makes me feel too risky. So what's the alternative? Insert real estate.
Right. And that's kind of how I got to, is if you can start stacking $100,000, $200,000 year in and year out, you're basically buying income for the future. You're buying growth and income. And that's kind of how I looked at the world, is how can I get there quickly and how can I do that at a scalable fashion and also be in the weeds of that business where I know what a good investment and bad investment is. So that's the exciting thing as well, to that point there. And it is really sad. I think, unfortunately, there's a lot of agents who are good salespeople, but not good business people. And
Oh
being a
yeah.
good salesperson and a business person are two different things. So it sounds like you probably were looking around and wanted more. And that's when the business acumen side of things came around, where you're kind of looking at that $2 million property, just kind of thinking to yourself, why not us? Why don't I do this? Why don't I operate this? Is that kind of, what you're looking around at? Like, you wanted to kind of take that next level?
So admittedly, starting out when I saw that opportunity, I said, this is going to help me be an investor. And whenever you start out on something, your vision is so wide, but you have to kind of start there. And then as you do the thing, your vision narrows. So when we got that done, on the back end of buying that $2 million portfolio, then it clicked for me. Oh my gosh, I just bought $80,000 worth of equity by me finding a deal, connecting people to the deal that had a need to get a return on their capital. And now I can do that again. And then it's a math game, right? So then you're like, if I do 2 or 3 of these deals a year, I could be doing this full time in 3 years. And so it was just kind of self-explanatory, but I can't say that I fully realized the power of it as I was doing it until I got to the backside of it.
Right. Well, it's amazing that at least you got there and you took that plunge. And was your intention at that point to kind of do that and then keep selling on top of it to supplement some of it in? And then when did you kind of, in your life cycle of things, decide, okay, no, this is what I'm kind of doing full time. This is the path I'm taking.
So, some people, they just hyperbolic. And I think they have maybe the experience and the resources to do that really quick. It's been more of a transition for me to get to that point. So 5 years ago, got my license. And I'm going to say in the last 12 months, finally got to a place where I'm able to focus on this full time. And we've gotten 3, 4 deals under our belt, each of them respective. So we did a mobile home park, seller finance deal. We did a 96 unit kind of in an outlier market that had some really low, it was a long-term owner. And there was about 60% of rental increases that were on the table just because they didn't want to rock the boat. And so we started to do those. And now it got to the point of like, okay, we're going to double down on this and go all in.
It's amazing. So let's talk about that. What is the strategy? You said you like to be in Ohio, the 3 Cs. I assume you're just an Ohio-based sponsor for now, but let's talk about your philosophical beliefs there, what you look for, the asset classes, and the strategy.
So, there's 5 ways to skin a cat and maybe more. But for us specifically,
Some would say more.
Yeah, depends how creative you are, right?
Right.
So being in the Midwest, a lot of our clients, they're looking to not move away from what they're doing. They have a lot of disposable income and cash flow is what speaks to them. It's what they're familiar with. A lot of maybe their investment thesis personally is just cash flow. Hey, so and so has 30 single family houses and it spins off, $15,000, $20,000 a month, but they want to transition out of that and still replace that income, but not have to be so hands on. And so a lot of our investments are very cash flow heavy. We hold for 5 to 10 years. We're not playing the appreciation game as much as somebody would maybe on the East Coast, West Coast, or in the Sun Belt, some of those high population growth areas. But we just find good deals that are fundamentally strong in good tertiary and secondary markets that the big guys would overlook, but we feel very confident from our market knowledge and being kind of close in proximity that we can oversee and create that value.
So what type of multifamily deals then would you kind of fit into that? Is it sub 100 units? What's kind of the buy box there that you have on the multifamily side of things?
So if it's a 45-minute radius of us, then we will kind of widen what our comfort level is to tackle a deal like that. So we would go down to probably 30 or 40 units. As we get further away from where we're in home base, we want to see 100 units, that 90 to 120. And the reason behind that is a lot of those have the economics to be able to have an on-site property manager or third-party property management in place. And then we can asset manage and be able to close that gap a little bit more. So from a mobile home park perspective, it's the same kind of metrics. Within a 45-minute radius, we have a 53 pad mobile home park, and we feel really confident with that. It's been a great investment for us. As we get out a little bit further, we want to see that scale so we can asset manage.
Right. So how do you find your opportunities then, I guess, on the multifamily and then on the mobile home side? I mean, naturally, you have to be pretty thrifty to find deals in residential real estate. I'm sure you brought some of that tenacity to this side of things now.
So I remember listening to a podcast on Bigger Pockets probably 3 years ago. And there were these two guys that sourced almost all of their deals off of CoStar. And they just pulled the back end data of owner information for properties that they would want to buy, and they went direct to seller. So we've kind of done a blended approach of that. We love broker relationships. To your point, I think you mentioned this on the podcast when we recorded the other day, is at a certain level and a certain scale, a seller's going to market a property through a broker in order to get that wide exposure, because the barrier to entry is so high to tackle a property like that. They want to have confidence that they're going to get the sophisticated buyer that can perform. So we do have a lot of broker relationships that we kind of network along that I-75 corridor. And then additionally, we have a lot of business clients that have just opened up their network to us. We've identified ourselves as somebody locally that is sophisticated enough to buy a bigger deal. And we're getting some off-market direct to seller connections. So I would say those two prongs are the biggest way we're sourcing deals right now.
Right. And then so you mentioned cash on cash is a big metric for a lot of your investors. I think people's expectations changed and, have different kind of thoughts, wants, beliefs on that. But what do you deem to be high at cash on cash? What are your deals kind of looking for? And then I have to imagine if they're pretty high on cash, you're going into some nice positive leverage.
Yeah, so we like to be able to get to an 8% return in year two, and then be able to kind of hold that and get up to like 10 or 11% in years 4 and 5. I know that sounds crazy depending on what area of the country you're investing in, but you can't usually have both, right? So you're going to go heavy on appreciation and maybe defer the cash flow, or you're going to get cash flow and maybe you're not going to appreciate as much. And so we're playing more on this side of the spectrum. So if we can get to 8% in year two or close to it, we're really happy.
Right. So what is like a typical going in cap rate, would you say, for some of the acquisitions that you've acquired, and then some of the deals that you maybe just missed out on, what you're looking at right now, I guess, holistically?
Well, there's like broker cap rates, and then there's cap rates that make sense to buy at. And for us, our entry level cap rate is going to be between 7 and 7.5% realistically. Obviously, you'd love to buy it at higher than that, but you're not going to buy deals if that's your expectation.
Right. And then what's the kind of the debt profile that you guys are utilizing? It sounds like your investors and yourselves are looking for that, longer term, 10-year period, 7-year hold there. So what is the debt instrument that you're seeking on these acquisitions?
So actually, it's a lot of local and regional banks that are going to do a 25-year amortization, a 5-5 ARM, maybe a 15-year term. So we want to know that we can kind of settle into that for the long haul. Right now, what's important to us is that we're negotiating that there's no prepayment penalty, or at least some kind of, like a 5, 4, 3, 2, 1, so that if interest rates do come down in the next 24 months, we're not locked into that product. We want to kind of keep our options open that way.
Very cool. So then let's talk about the mobile home side of things. What about mobile homes gets you so excited? There's not been that many people that have talked about mobile homes on this channel before. So be curious to hear your perspective there, how that underwriting process and acquisition process looks, if it's different, kind of, can you speak to that, please?
Yeah, so mobile home parks were kind of like this ugly duckling thing that nobody wanted to talk about 7 or 8 years ago. And then it got a lot of institutional attention. I think people got crowded out of some of the more core assets that people were going after. So they started to explore this, and they were like, oh my gosh, this is a very kind of ripe environment where there's a lot of mom and pop owners that are ignorant to the value of what they have, because everybody just looks at it as like, oh, it's a field with some infrastructure and you have all these mobiles that are dilapidated. Because of rental appreciation over the last decade, the story on mobile home parks has changed drastically. You compound that with the affordable living crisis that we're seeing nationwide. That entry-level housing has more demand on it than I think it's had in a long time. And so we were hearing these things, rumblings and stuff like that. We had a client come to us who was a long time kind of a legacy owner. He was ready to pass the baton on. And so we took a look at the numbers, and we had known enough through our podcast from other mobile home park operators that the space that you want to play in, there's two strategies. There's, I want to own all the mobiles in my park and rent those out to tenants. Maintenance costs really high because you're on the hook for all of it. Or I just want to own the pads, and I want to make lot rent and alleviate the burden of the mobile homes by having tenant-owned homes. And that's the strategy that we've elected to do. So when we bought the mobile home park, we had 53 pads. 13 of those we owned park-owned homes, and we've since divested ourselves of about 7 or 8 of those, and we'll hopefully divest the rest of them in the next 2 years. And then all we do is we just run park maintenance on the infrastructure, and we collect rents. We were able to take those lot rents and bring them up 40% in the first 6 months. And now we're just going to continue to incrementally increase those.
Incredible. Incredible. So what would you say the biggest differences is between kind of operating, asset managing, and property managing mobile homes as well as multifamily? Would you say they're similar? They're different? How would you compare and contrast?
That's a good, they're very different. So on one hand, when we get to the mobile home park, when we divest ourselves of those remaining mobile homes, then I think it's going to be really smooth sailing. The process of executing a business plan always is going to be more hands-on. The turnover rate and some of the responsibility from property managing a multifamily asset is more intensive, in my opinion. The only caveat to that is I think the tenant demographic maybe is a little more tricky to deal with in a mobile home park because it's more of that entry-level housing. So there's kind of some push-pull variables there. But overall, I think the mobile home park, once we're to a stabilized point, will be a very passive scenario.
Right. So let's talk about some of the benefits that mobile home investing has. I'm pretty sure there's wild depreciation, but can you kind of speak to some of the benefits you get as an investor to that space, and then also maybe some of the metrics that you get as a mobile park owner operator, and kind of the what's in it for you as an investor and then for you as the operator?
So again, this was all hearsay until we bought the park, and then we actually saw proof of concept. So we bought the park for like 1.75. The value of the land was like 250,000, 200,000. So there was like a $1.5 million depreciation that we could pass on to our investors. We were able to accelerate all of that in the first year. And so effectively, everybody who placed capital into our investment was able to underwrite or get about a 20% discount on their initial investment because of how it affected their taxes. Now, obviously, talk to your tax consultant. They're going to apply that to your situation. But that was the outcome of that. When we saw that, everybody was so excited because a lot of these guys are very high net worth individuals, and that had a massive needle mover on their personal tax liabilities.
Amazing. So, how would you, I guess, if you were to do, let's say, 10 deals in a year, how many would you want them to be mobile homes if it was like for like, and how many would you want them to be apartments if there was no advantage from what you saw from metrics perspective?
So I think, one second. I think for us, the mobile home park lift on the front end is heavy because there's more moving parts and pieces. And a lot of the multifamily stuff that we're looking for is relatively stabilized, and there's maybe already a third party management company in place. So I would say 70-30. We would love to do 7 multifamily deals and about 3 mobile home park deals in a year if we were doing 10, just because you're able to systematize the multifamily side of things for the types of properties that we're looking for. And we can kind of overlay some of those SOPs a lot easier. Whereas each mobile home park has its own, quirks and different things going on there. The ratio of tenant-owned home and park-owned homes is more. Bringing in lots and infilling a mobile home park is tricky. So that initial business plan can be pretty intensive.
Right. Okay. And then what are some of the cash flow you get? I know you mentioned multifamily, you want to get to about 8% after year, 2 or so roughly, right? What is like the cash flow and kind of the breakdown there? Because I'm also pretty confident that similarly to kind of the play that you have for multifamily, it's more holistically, hey, you're cash flow driven investors, and then whatever the appreciation gets, kind of the cherry on top. That's also very similar to mobile homes, is it not?
No, it's well said. I mean, so for the deal that we purchased, we were able to get to that 8% in year 2. The big difference was they'll be at like 10 to 12% here shortly. And so it'll cash flow and outperform the multifamilies that we would underwrite on a cash on like just cash distributions in a year. The the big linchpin is the accelerated tax depreciation and how much more you can take as opposed to multifamily. And I have a dozen investors that are like, the next mobile home park you get, you let me know, because I have a lot of money I would want to put in just on the tax depreciation alone.
Yeah, that's one of the massive variables that you get in that space there for sure. And I'm so happy you highlighted that because it is pretty wild. That is one thing that as bonus depreciation is sunsetting for those who know. It may come back, it may not, but let's just pretend in the world that it doesn't come back. Let's use as the letter of the law to be enforced today without any amendments to that change there. Mobile homes are giving you, what multifamily was before, but even actually more, I'd argue. So it's pretty crazy that that's, still intact there because it's really looked at as a lot as equipment and gear and stuff. And I guess I'm not probably using the right phrasing there, but that's how they look at these parks.
Yeah, a lot of land improvements. I mean, that's really the bulk of what it is, and it's disproportionate via the tax code. And there are more people that want us to buy mobile home parks than we would want to buy, because there's a
Yes.
lot of mobile home parks that are
What?
not interesting.
Yeah. So what you're saying is there is more equity demand than you find there to be good deals in that mobile home industry. So let's talk about that. Why do you say that? Is it because there's just not enough meat on the bone? Is it because the story's not right? Can you elaborate on that kind of comment there, please? Because that was very interesting. Because we too feel that way about multifamily right now. For the record, we have so much equity demand right now. We're probably saying no to about, and I'm not even exaggerating here, $15 million on our last 2 deals. Like if it was
Wow.
a $30 million raise, I think we could comfortably hit it. We probably have to be working really hard, but we could get there. Unfortunately, there's just not as many deals that make sense in our specific niche buy box. I'm so happy you're disciplined there like us, because if we buy something, it's a big deal, right? That means
Yeah.
we freaking love it, not because we can raise the money for it.
So anybody who's listening to this, they need to read the book, The Road Less Stupid. And it was like the rich dad for Rich Dad, Poor Dad. That's him writing the book. And he describes in 1989 how he lost everything because of the real estate crash. And he then outlines over the course of like 4 pages in the book, 100 different lessons that he learned from that. And one of those things that he highlights is just because capital is easy and financing is easy doesn't mean that a deal should be bought. And so Obviously, some of those variables will change a little bit, but we have a lot of capital pushing us, trying to push us into the marketplace to find something. And to this point, there's a lot of money on the sidelines still, which is pretty crazy. And part of, for us, we feel the responsibility of when we say that when we put a pro forma in front of somebody, we take that really seriously because that's our reputation. And that's what's going to create an experience for somebody that would want to reinvest or bring their friends into our company is by proven track record, following through on what we say we're going to do. So everybody loves mobile home parks at a face value, but they don't understand the skill level, I'm going to say sophistication, not because I'm a sophisticated and a person, but there's a very specific strategy that's required to drive that and manage it well. The big thing about mobile home parks is there are the tenant demographic, the quality of the mobile homes, and this like utility situation are some of the three biggest variables that we look for. So well and septic, not interested. The burden for that on an EPA level per state is variant, right? So Michigan, their requirements from a state level for well and septic is very different than Ohio. And even in Ohio, there's like consistent ongoing regulation for having a well going to your mobile home. Now, a lot of these mobile homes, the beautiful part is when they were developed, you can put them anywhere. Well, that's not a great thing because they're out in the middle of a cornfield away from city utilities. That's not an investment that I really want to get into. I want to benefit off of those city utilities because
Well,
now,
also, any deal like that, it's going to be trouble to sell it on the back end, right? Like, yeah, maybe you can manufacture cash flow, but if there's no market for it, then you're the sucker who bought it, right?
exactly. Just because it's easy to get in does not mean is it's going to be easy to get out. And so you have to be really careful with that. And there's a lot of mom and pop owners that, they'll sell or finance, they'll roll out these crazy terms and you're like, this is like just money waiting to be printed. But you have to think about your exit. You have to think about how can I position this? So we take that into consideration. Can we hook up to city utilities? Is that CapEx that we would raise on the front end to make that happen? How would that make this park more saleable? If we can't do that, we're going to pass on it. The age of the mobile home parks, if 14 of those are being rented, but they're really tear downs, for me to have 14 vacant lots is a huge burden on me as a park owner because bringing in mobile homes is a very cost intensive and time intensive scenario. And those lease ups are not like a turnover on a multifamily. Your open time is going to be a lot longer. So we look at those things. Those are the big factors, the story that you kind of alluded to.
Right. And then I guess, story. How important is a story for you on the entrance of a deal when you underwrite deals? Do you even care about it on your end? Because investors so often do care about it, which I have kind of my own comments on it because they're kind of looking for the why this deal. But is that important for you to know the story, maybe learn a bit more about the sellers if it's mom and pop? Obviously you're not in the fully institutional space on all the assets that you acquire. Naturally, as you mentioned, when you get to that, 80 plus unit, we're kind of getting to that level there. But,
Mhm.
that said, how important is a story for you as a operator when you acquire a deal? Or are you just looking at, hey, I don't want to be blind or, get sold some, sob stories why this deal is good. I'm just kind of cut and dry numbers, numbers, numbers.
I mean, I think we're always trying to hold the tension of being win-win. I have a fiduciary responsibility. Like the burden of my responsibility is to my investors first. And so that's just the expectation from the beginning. So when we approach this, though, we want to build relationships and build into people along the way. And so we look for ways to do that. So learning someone's story, I think, is helpful for a dual purpose. A, it's to figure out how do you work towards a win-win situation. And then B, it's what are the uncovering the value drivers then that I can communicate to my investors? Or what is something within this that would allow us to structure something more advantageous, like a seller finance deal? I mean, the one deal that we were able to work, excuse me, with the other owner was an 8-year balloon, a 30-year amortization at 4.5% interest. And so learning his story, sitting down with him, gave us the information we needed to structure a deal like that because he just wanted mailbox money. Well, getting financing through a bank for a mobile home park is not going to be able to beat the terms that we were able to negotiate with him. So I think it's relevant to structuring the deal and working towards a win-win situation.
Right. That makes sense. So, what are some of the key metrics that get you excited and nervous for a deal that you're going to pursue?
Yeah, so obviously under rent. I mean, that's the big thing, right? Is what is the floor rent at today? What do we think we can achieve? There's not a lot of variation where we're at, kind of in Northwest Ohio, for mobile home park lot rents. It's going to be 400 to 500 for lot rent. So when we see a mom and pop owner who's at 275 or 300, that's a lot of margin for us to be able to just very organically catch up to what the market is. And they're so burnt out, and usually they're managing it very poor, that seems very daunting to them, or they have limiting beliefs that could not happen through their park. But we know what's going on kind of in the wider market that way. From a multifamily perspective, I think one of the big things is, what do we have a way to come in and create value through operationalizing it better? Because if our business plan just rests alone on unit turnovers and just coming in and putting in amenities, all of those cost things have gone exponentially. The cost of doing turnovers, construction related stuff, that just got a premium. So if we can find value in changing some, contract services and renegotiating some stuff, bringing fiber optic into the property and then billing that back to the tenants, getting creative on those side of things, we get excited about that.
Very cool. Also, with that said, is there ever any no-goes that you have in the multifamily space? You mentioned some of them seemingly for mobile homes, which is, hey, if you're not on city services, it's, you're not doing it. So what are the no-goes for multi?
When you get into Class C properties, one of the reasons it's Class C is the age. And so, perfect example, in my backyard, there's a 120 plus unit, 3-story building that has been owned by an out of state investment group. And it's like the pinnacle perfect investment because it's located in a great part of town. The property seems to have a lot of deferred maintenance on it. And it came through the sheriff auction. Okay, it was a $4 million purchase. And I was in communication with the receivership company about this property to get some information early before it hit the auction block. One of the things that we found out, and this is a great due diligence story, is call local contractors for a property that's in that community, especially something with deferred maintenance. If it's got deferred maintenance, then a lot of plumbers and electricians have probably serviced that property just as a way to keep the Band-Aids on. So I called a local plumber who was a long time in the area. I said, tell me what you know about this property. And he he began to reveal to me that the main sewer line that was running down the hallway when this was originally developed was set right on the dirt, and it was cast iron. And the underside of that had rusted out, and there was like an 1.5 inch gap that was just going straight down into the earth underneath. That had happened so long, and he had snaked that it had eroded the dirt, actually the width of the hallway. And so there was like some structural compromise there. So we were able to find that out. So all that to say is, I hate cast iron plumbing in multifamily properties. So that's why we try and buy something newer, like 1980s or newer, to stay away from that.
That makes full sense. And, just the older you go, you, of course, can make a lot of money on those deals. I think those were deals that people made probably the most money on at that last ending part of the cycle. But those are also the properties now that people wish they didn't buy too, seemingly as well, because, they projected certain rents. Those rents are not going up. Rents are actually decreasing in a lot of instances, and people aren't able to pay. There's bad debt, delinquency, the whole nine. There are headaches to manage there. So to your point, some of those older deals that maybe C plus, B minus inherently are the ones that are still in a price discovery period, as opposed to the higher end multifamily stuff, 1995 or newer, you could call it. There's a market for that right now. Those are the deals that are trading. And actually, in fact, about 80% of multifamily trades that have occurred actually have been 2017 vintage or newer, which is crazy to think about, but It makes sense because that's more of a fluid market. So it's just interesting to think about there. There's not a one size fits all strategy to make money, but it's certainly a risk premium you have to factor when you get into older properties.
Absolutely, man. And this would be one question for you. This is something that we're looking into. we're seeing a lot of AMI properties, right? Something that was, developed, built 1990s. They had kind of a 30-year contract with the government to do some kind of blended subsidized housing scenario. And those are now coming to the end of their life cycle so that somebody could come in and take those to full market rent. And not be restricted by whatever those average medium income things are. Have you guys looked into those kinds of scenarios? Are you seeing owners bring those to market with a few years left before those get released?
No, that's not really our strategy, personally. And I think there's two ways to look at it. You can create alpha by buying that and call it with a couple years left, holding it, and then re-tenanting the property and making it more of a market rent play. We do the latter. We buy a market rate deal and then place it there. So there's tons of money to be made and tons of good you could do in the affordable space, but we don't do it the way you kind of posture it. But there's a lot of money to be made there, that said.
Awesome. Yeah, just
Yeah.
curious.
Yeah, no, for sure. With that said, of kind of wrapping up some questions here, you've been such a great guest. What do you think will do best coming up here? And I have to imagine it's probably anything housing related because you didn't mention anything that's, luxury necessity here. Luxury would be office, retail, things of that nature, necessities, housing, which you mentioned you're in kind of the two, frankly, let's call it lower end of the economic spectrum of what you own and operate, which is a great strategy. But that said, what do you think will do best coming up and what do you think will struggle most coming up?
And there's a lot of people that have kind of downplayed multifamily, and maybe this is just my answer because it's what I understand. But I do think that there is such an upward pressure on housing right now, and there is still a wide gap for home ownership. So this is kind of going back to my realtor license. I'm seeing a lot of people that would love to be homeowners that are just financially not able to do that because of the cost of inflation and feeling that on their, just their finances. And then realizing that home ownership feels kind of unattainable because housing prices really haven't corrected downward. They're more stagnating. And so it seems out of reach for them. So I think there's upward pressure on multifamily. We will still see good rent growth. And then on the buyer side of multifamily, I think there's people that just overpaid or didn't have good fundamentals when things were really frothy. And there's going to be some good opportunities to buy like good assets that are newer, like to your point, they were just overpaid for. So those operators are going to lose their initial equity, and there's going to be maybe some margin for someone to buy a stabilized asset.
Yeah, no, I couldn't agree with that more. And it's kind of funny on the home side. And I just want to really put this in people's brains as to the thesis as to why multifamily. People, typically speaking, I think live into apartments, I think on average to like 32. Well, I think that was mark to market. Now the people will be living to 37 in apartments. So that is a lot more people living in apartments for drastically longer, which is only going to make the inventory right now that much more valuable if you can acquire it and own it and afford it and kind of manage it. But also you mentioned pricing stays stagnant. Well, the home price has stayed stagnant, but you know what has not stayed stagnant is the mortgage payments and how
Yeah.
expensive insurance is and property taxes are, so on and so forth. The fact that housing prices by and large have stayed pretty, close to where it was at the top of the market. In most instances, there's some other markets with other problems there, but by and large, let's just call Arizona where I live, pricing hasn't dropped off, but mortgages are 2 times at least more expensive as what they were before. Actually in some cases 3 times depending on where you locked in your mortgage rate, right? Mortgages right now are really actually close to about 6.8 to 7.2% because even post rate cut, the 10-year treasury is still higher than when it was actually pre-rate cut, which is nuts to say. So all that being said, people are going to be forced to rent for a lot longer than they think. I mean, the bond market right now is really telling us something, right? The bond market is saying, hey, bonds are never really wrong, right? And they're telling us they need to meet the fours right now. That's kind of crazy to think.
Yeah. And you said it way better than I could have. We're just seeing a lot of the symptoms of that. And it really is a widespread issue. So I don't even think that that's a regionalized thing. I think if anything's regionalized, it's markets that have oversupply that are now feeling the effects of that. But those are the minority. And by and large, most of our country is feeling that dynamic that you just explained.
And I think another thing to think about as well is all the delivery is about to be unwound and kind of done by 2026 for the most part, right? So let's talk about the places that have a ton of supply. That's Austin, Texas. DFW has a lot of supply coming on, but it's absorbing it in Phoenix, Arizona. Well, I'm very confident that people are moving to Phoenix and Austin moving forward. perpetually. It's just not really an if when thing. It's just, it will happen. It's just going to take some time for that to be fleshed out, which could create many good opportunities for buying in a couple of years as well. So for every, unfortunate situation that comes on from the macro or the micro perspective, there is a win that can be done if you play your cards correctly.
I think it's re-educating investors too of that. We are not 2018, 2019. Investing has changed. And so from a passive investor perspective, you have to retool your mindset of what are competitive returns today. They're still out there, but they're not going to look like what it did. No one's taking a deal full cycle in 18 months. It's not going to happen. You have to really sharpen your pencil. You have to fine tune your operating skills, and you're probably going to hang in there for 3 to 5 years, the full cycle that's there. And to your point, in 2026, like things are just being delayed, but everything is still there that you made your initial assumptions off of.
Yes. Let's talk about what you think will not do well.
So yeah, I mean, the glaring thing is office, and I know everybody's talked about that, so there's no surprises there. You drive around, like just drive around a big city. I mean, it's just massive, massive leases that are going away, and it's kind of crazy.
Thank you so much for being on the show. For those listeners who've tuned in, we appreciate you, and we'll see you next week. Peace.